Hello, I've gathered some historical data that was put together by JP Morgan that I think you'll find useful as we go through these times. And I want you to have this so depending on the day and some of the news you're hearing, you have it as a resource that you can go back and look through or listen to when you feel like you need to hear some of these messages. I hope this finds your family in good health, and that continues to be the case for you as we go through this time that is the most important thing. And I want to talk a little bit about some of the economic things we might expect based on history. I want to start with a broad look at the S&P 500 over the past 2 decades, showing both volatility and progress. The chart shows the price of the S&P 500 since 1996, annotating key values at key points and including a box with valuations during prior market peaks. Overall, it's been a pretty spectacular roller coaster. We'll start in 1996 with the market rising over 100% to hit a peak in March of 2000. It then fell by 49% over the following 2.5 years before rallying again 101% to hit a peak in October of 2007. Then we lived through the global financial crisis, in which the market fell more than 57% to its low in March of 2009. Since then, we have rallied over 300%. Here we are today. The key point in this next slide is that long-term investors should not overreact to short-term volatility. The bars in this chart show the price returns for the S&P 500 for each year since 1980. The dots, the red dots here, show the peak to trough decline each year. The dots are somewhat inevitable. The market does not move in a straight line, and each year will contain some sort of correction. In fact, the average peak to trough decline over the last 40 years has been close to 14%. Despite this, 75% of the time, the market ends the year in positive territory. Volatility should increase as markets continue to mature, but the message is clear. History is heavily on the side of those who do not overreact to volatility. Now we will consider equity stock market volatility since the financial crisis. The chart on the top shows the price level of the S&P 500 since 2010, with major drawdowns annotated. The chart on the bottom shows the volatility index measure over the same time period. Notice the spikes in volatility, as well as the notes that provide market commentary as to what was happening in the world to cause the spikes. A few things are clear. Market corrections are not infrequent occurrences, but the source of that volatility is constantly in flux. Over time, volatility subsides and markets resume their upward ascent. This chart can provide some perspective on where we have been and where we might be headed going forward. As we consider where we have been and where we might be headed, this page provides us with additional perspective as to what we may expect. On the left-hand side, you will see a chart that shows that from the peak on February 19th through April 7th, the S&P 500 declined by 21%. If we look at the chart, it will demonstrate how much of a return is needed for a given time frame to recover to that peak. For example, if the time frame is 4 years, it would require an 8% annual return to make it back to the peak. On the right, you can see the average returns around a bear market based on the previous 4 bear markets. Right here is the 12 months prior. Here's the drawdown. The different markets that we're tracking are highlighted up here. And then over here's the 12 months following the drawdown, what the recovery has looked like. The 12-month period historically has an average return, or I'm sorry, the 12-month recovery period historically has an average return of 40%. As you consider these charts and those that we have already seen, I invite you to ask yourself the following question. Is it likely that I will achieve my goals if markets behave as they historically have? So far, we have only considered the US equity market. Let's look at what happens when we consider owning bonds in combination. This page speaks to the importance of time and diversification. We show stock returns, bond returns, and a 50-50 mix. That's a simplistic version of diversification. This shows the very best and the very worst returns for each of the different time periods. The 1, 5, 10, and 20-year rolling time frames. The first observation is simple. If your time frame is only 1 year, almost anything can be expected in the stock market. We have seen returns as good as 47% on the upside and as bad as 39% on the downside. A large range of outcomes is possible with a 1-year time horizon. When we are using stocks in a portfolio, it is important to have longer term time horizons. Looking at the 5, 10, and 20-year time horizons, we see the range of outcomes shrinks in size and is much more positive. Lastly, zooming in on the diversification strategy, that's this one, the gray, you can see that it never has had a negative return during the 5-year, 10-year, or 20-year time frames, thus making the case for diversification and time to diminish risk. Finally, let's tie it all together. This final page speaks to the importance of diversification and to the damaging impact of investor behavior. The 2 blue lines, so this light blue and this dark blue line, in the top chart represent a 40-60 and a 60-40 stock bond portfolio, while this olive green line represents the S&P 500 alone. The punchline that I would like you to observe is that while all 3 portfolios end up more or less in the same place, right? We're all right about there. And that would be great if not for the ride being so different in how they got there. While the S&P 500 lost about 50% of its value during the financial crisis, so that's right here, the diversified portfolios lost half as much as that. They're up here. As well, the diversified portfolios have had much smoother ride upwards since then. The rest of the chart is even more compelling. Despite the fact that the green line, or the stock market, has had a 200% plus run and outperformed a broadly diversified portfolio, every year since 2009, the account values of the diversified portfolios would have been higher throughout the entire experience due to a lesser loss during the downturn. All those years. Then I want you to notice the chart on the bottom. There's an orange box over here labeled average investor. This is based on an annual study by an organization called Dalbar, which measures the totals and timing of mutual fund flows by individual investors. Now, unfortunately, year after year after year, the conclusion is the same. Due to emotional and behavioral biases, mutual fund flows of the average investor have received a return of only 2.5% per year over the last 20 years. This is significantly lower than the 10 other asset classes that we show on this page. The orange bar shows what happens when investors do all the wrong things at all the wrong times for what seems like the right reasons. On the left-hand side, by contrast, a simple 60-40 mix of stocks and bonds shows much better results. So the message I would like to leave you with is this. The average investor should leave emotions out, have a plan, and stick to that plan. Reasonably, this plan should involve some form of diversification. Now that we're experiencing a downturn, having a plan, time, and diversification are crucial to recover in the economy that emerges.